The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. I'd like to remind everyone to please subscribe, hit that subscribe button, and make sure you get the newest podcasts as they're released. And if you can think of anyone who might benefit from seeing these, friends, family, coworkers, feel free to forward that link on to them. That would help us out a great deal. We appreciate that.
And we have a month end, or actually start of every month, we do a stock market update webinar. Go to our website. The shortcut to the website is iriradio.com, which is a memoriam to the fact that we spent 14 years on the radio before we started doing podcasts.
That's where this used to be. That's right.
But we're still here in the early part of the year, and there is a magnitude of advertising to help you get the important decision that you need. When to buy, what to buy, and when to sell it. And everybody's looking for a black and white answer. Just tell me what and when. It's kind of like husbands talking to their wives. Just tell me what and when I'm supposed to do whatever it is that I'm supposed to do. And that's what investors are looking for. And particularly with the difficult market that we've had over the last couple of years. Now, I say difficult market, but that's a matter of perspective. I had a client meeting the other day, and we were talking about recent years and performance, expectations going forward. And he made a statement, which is pretty normal. It's a pretty common assumption that the market's been up a ton over the last couple of years, and me not so much.
Right.
What gives? Well, what gives is an important question, because you've probably heard of the Magnificent Seven technology stocks, which have driven the stock market indexes, the S&P and the NASDAQ, to new all-time highs. Last year, the S&P had 46 or 47 new all-time highs in 1 year, driven by 7 stocks. Maybe 10 on occasion. So what's going on with the rest of it? The rest of it, that's why I said the rest of it's struggling. That's why I said it's been a difficult environment for investors ever since COVID came to mess up our lives. and we're still dealing with the repercussions of it. Do you want to add anything to that, Perry?
Well, just that we're mostly dealing with the repercussions to the response to COVID. That was the big problem, shutting down the world economy, trying to get things back together. And then on the backside of that, when the market did start to get itself back together, everything coalesced in that handful of large cap tech stocks. And that, like you said, Don, that's the prime driver. Doesn't mean nothing else was going up, but those were the only ones that are really meaningfully moving, say the S&P 500, large cap index. So that means there's a whole lot of other securities that aren't doing very well. And that's kind of been the story of the S&P 500 for a couple of years now. It's really heavily dominated by large cap tech. Everything else is either along for the ride or even losing market share, losing capital, prices going down in their securities, but it's all covered up by the Magnificent Seven, all by those big large cap tech stocks.
So it kind of reminds me of the change that's gone on with the big stocks. And actually, there's some research that was done by a number of firms. Ritholtz companies pushed out some data and doing comparisons. And they went back a number of years to 2015 and took a look at the top 10, not just the top 7, but broadened it a little bit. And if we go back to 2015, so roughly 10 years ago, the top 10 stocks were worth $3.6 trillion. That's a lot of money. but relative to the rest of the market, it wasn't all that exceptional. In a
Right.
big market, what's 4 trillion, give or take a little. But here
Sure.
we are today, and those same 10 stocks are worth 5 times more. They're worth more than $20 trillion. The rest of the market hasn't grown all that much, but that's a big deal. And it kind of reminds me, if you have grandchildren and you don't see them all the time, maybe a couple of years ago you saw one of your grandsons before he entered puberty, and now either he visits you or you visit him, and all of a sudden he's nearly 6 feet tall, and you're saying, how did that happen?
Hey, Grandpa, let's have a beer. Yeah.
Yeah.
What?
Well, I can't do that because I'm still in high school.
Yeah.
But I am turning up for football.
There we go.
Well, that's kind of what's happened with these 10 major stocks, is they have become disproportionately overweight, and from a traditional valuation standpoint, extended valuation has made them very pricey on a relative basis. Whether you look at price to earnings, um, price price to cash flow, new sales. I mean, they are dominating the business. They're capturing business. That's part of why they're there. And they're tech companies, so they offer optimism and a promise for what's likely to go ahead, what the future has to hold. And therein lies the reason why these have become such a magnet for investor money. It doesn't mean
And
that's the only place you should be.
that's the key. It's important to pay attention to that, because if you're looking at things like, as many people do, the S&P 500, which is on the news every day, and you're thinking, well, I'm really diversified in there. I'm buying 500 stocks. This is probably going to be okay. And then when you look under the hood a bit and you realize, well, there's just 7 to 10 stocks that are actually getting all the return, and 490 stocks that are really just along for the ride. So all of a sudden, you're actually buying a very concentrated position, probably more than you'd want. You would probably never be that concentrated just in technology, if you were choosing them. But when you buy that index and it's so heavily overweight in those large cap tech companies, that's what you end up with. It's just important to understand that's what's happening. That's where the returns are, and because it's a cap weighted index, the bigger those companies get, the larger share of your investment they get also. And so it's not quite as diversified as you may think. So that can increase the risk. As you said, Don, as valuations get more and more extended, you get a big pullback in those 7 to 10 stocks. It's really going to drive the index the other direction also. So it's important to keep track of, and it can give you some understanding as to maybe why some of the other things you own aren't moving, even though the index is. It's really not the whole index. It's a really small portion of it.
What also is the exact problem that people have when they own diversified portfolios. And who has not been told to diversify your portfolio? That's a major risk management tool.
Sure.
But what do you diversify into? Laggards, things that aren't keeping up with what you perceive as your appropriate benchmark. The S&P 500 usually is the case. Most people's real benchmark is something else, but they use the S&P to judge their portfolio or their manager, not understanding that diversification is going to hold that return back. And that
Right.
affects your financial plan, your retirement plan. What are you going to do for assumptions for that? If you're using the S&P, the long-term average runs somewhere between 8 and 10%, depending on your starting point. But your real return for your portfolio is probably somewhere between 5 and 8, depending on how you're diversified. It
Sure.
requires a sense of reality. But when you're turning around and saying, well, I don't want to pay a premium for just that highly concentrated tech portfolio, and that's an issue because most everybody knows they don't want to pay too much, overpay. My wife is really adamant about looking for a bargain on whatever it is she's going to buy. And that's true for many stockholders. So when you turn around and you look at the valuations, what you find is that the Mag 7 on a forward price earnings ratio are priced out about 31 times earnings. The S&P at almost 22, and you look at mid cap and small cap at 16. And then there's the argument, which is historically true, that small cap stocks outperform mid cap stocks over time. What's not said is with a great deal more volatility and a
Sure.
great deal more uncertainty as to outcome. But even though the small cap have been cheap on a relative basis in recent years and touted as a place to buy bargains because small cap outperforms in the long run, it comes with a problem. Let's just take a look at what's actually happened with the Russell 2000. So here we are in the run up out of COVID. The rally peaked in January of 22, and it's been downhill and sideways and an attempted recovery which hasn't persisted. So you go buy something cheap, but then don't complain about not keeping up with the index. This is a conundrum for portfolio construction, for risk management, and for expectations about what a manager should provide. How your portfolio is structured, how it's monitored, and how decisions are made to get rid of weak positions in your portfolio are all things you need to understand. We have a process for dealing with that, don't we, Perry?
We do, and one of the strongest portions of that you don't get with that pie chart manager is when do you take things out of the portfolio? The buy and hold pie chart asset allocation model says you buy it and you just leave it in there. If it's doing poorly, good, it's supposed to. Part of your portfolio is always supposed to be going down in that process. That's a function of the process. And so when things are going down, they're ignored. And he may get a call from your broker telling you, hey, relax, everything's going to be fine because some other part of it hopefully is going up. But part of it's always supposed to be going down. So we're just going to ignore that. Instead of that, we really try to say, hey, if we're losing money in any given investing sector, let's get rid of that. Let's at least lighten up substantially and maybe just move out of it altogether until it turns around. And then you can follow the money back in. But if it's become a drag on the portfolio, there's no reason to let it stay because you never know how long that's going to be. It could easily, be negative returns for 5-10 years. You don't need that in your portfolio. That's in no one's rules for their portfolio. Let's hope part of my portfolio is always going down. But that's a functional part of being a pie chart investor all the time.
So we go back to the tech bubble, which the public did not want to recognize was a bubble at its peak, and many professional managers didn't either because, well, for one thing, clients would complain if you started selling overpriced assets that were technology based, that were internet forward-looking businesses. And I mean, I remember dealing with the manager at the time. He said, I can't believe the number of people who are calling in and canceling accounts because I'm selling Microsoft in 2000.
Right.
Well, that particular manager in his technology fund went through 2000 and 2001 without losing any money, where in 2001, technology fund losses were as much as 50%. And he was actually in 2001, that portfolio was plus 15 versus a minus 50 elsewhere. And the closest performing, best performing other funds I looked at that time was about a minus 15. But that was somebody who had an orientation to get rid of risk in the portfolio.
There you go.
So instead of being married to Microsoft at the time, which took 13 years to get back to even, as a matter of fact, that's the problem that you get in terms of benchmarking yourself to a particular index without understanding what's driving the return and being unwilling to rotate to other sectors of the market. If this begins to make sense to you, You probably have some friends, co-workers, family members who might need to listen to the same thing to rethink some of the risk that they've inherently ignored in their portfolio. Share the link for this podcast. You can give us a call. The phone number is here on the screen momentarily. Sign up to subscribe to these so you don't miss a publication. We thank you for listening. We continue to do more. We post it twice a week, and stay tuned. And if you want to register for the February 1 stock market update, go to our website, iriradio.com. It's pre-registered, Saturday morning for an hour, and you'll learn a lot about making yourself better positioned for what goes on in the market. Have a great day.